Good day. I wanted to talk to you today about having a short options position and kind of what to expect and kind of how it works. And I wanted to use the current position that I have in GameStop. Now, the position I have on is a condor, so I am not net short options. So I don't have naked options here. However, the options that I've sold are worth a lot more than the options I bought, and thus I'm collecting decay every day. Let's take a look at the Greeks associated with this position. Now, Greeks, of course, are a way of measuring one's risk. So if I pull up the Analyze tab here and we take a look, we can see here a delta of -74. Now, what that means is you could use that as a stock equivalent. So the options position I have is the equivalent of being short 74 shares of this stock right here. However, we can see as we move across these Greeks, if we go to gamma, I'm short 2 gamma. That means that for every dollar the stock moves down, I lose 2 deltas. So right here, I'm short 74 deltas. Down a buck to 160.66, I'm only short 72 deltas. If we move down 10% to 145 here, the next line down. Now these 3 lines here show my risk at different price levels. The middle line is where we are now. The one above it is a stock up 10%. The one below it is stock down 10%. So you can see as the stock moves down, my delta decreases, and as the stock moves up, my delta increases. So the deltas are kind of moving against me over time due to the fact that I am short options. That's kind of how it works. And we can see a theta here of 65, right? So what this means is that the position is collecting $65 a day in decay. But I don't want to stop there with the explanation, because the way this works is not as orderly as maybe the numbers would have you think. So, for example, if the stock were to just stay 161, open and close here, it is pretty unlikely that the P&L would show us collecting exactly $67. This is kind of a rough estimate, and it doesn't come in every day exactly $67. It might be nothing happens for 3 days, and then one day it all comes in. Or today it could show it all coming in for the next week, and then tomorrow it comes back out again. So this number is a rough estimate, and certainly over time, you know, if the stock stayed here for 3 weeks, we would certainly be collecting money. But this number doesn't always come in an orderly fashion. However, it is accurate as far as that we are collecting money over time. But to understand better this number, we can try to look at where it comes from. And this is this theta number is a sum total of the theta of all of our options, right? So we have 4 different option strikes in this position right now. And these are the options. They're all in September, expiring in about 35 days. Let's see, exactly 36 days. And we own the, well, you can see we own the 180 put, we're short the 170 put, we're short the 100 put, and we own the 90 put. So it's a condor. We want the stock to close somewhere between 170 and 100 on expiration for maximum profitability. So right now, with it up $3, trading 162, we're getting dangerously close to this 170 level, which is concerning. Optimally, I would love the stock to just move to like 140, 130, so I don't kind of have to worry about it so much. But the key to making money in a position where we're collecting theta every day, since it doesn't always come in, you know, every day, is you just kind of have to let it work for you and leave it, which can be a tough thing to do, especially when you've got a stock that's moving around all over the price. So let's take a look and see what's happened over the last little while with this position. And then I'm going to go back to these Greeks. So here is the chart for 20 days, and you can see it was as high as 195, it was as low as 145. We kind of need it below 170, which is right that level right there by in 35 days. So it seems like it has a chance, certainly a reasonable chance of doing that, but it's not a foregone conclusion at all. There's risk there. And once again, if the stock does go below 100, then we have problems to the downside as well. But back to the Greeks down here. If we look at theta, we can look per option, and we can see, all right, the 180 put that we're short is we're collecting. I'm sorry, the 180 put that we're long is costing us $692.90 a day, and the 170 put we're short, we are collecting. Well, it just switched, but it's basically just $1 discrepancy between these two options right now. Now that does change over time, and it is based on the current marks, but this information, you can see where we get that overall theta of 71 from. It's mostly coming from the decay between the 90 and the 100 put right now. And the reason for that is these puts are so far out of the money that the model is making them decay pretty quickly right now, right? The 170-80 put spread has a pretty good chance right now. We're pretty close to that 170 strike, but the 190 put spread, we're so far away from it that that's decaying pretty rapidly right now. So most of our theta we're collecting is coming from that way out of the money put spread, the 190. And it's important that you go and you dig into these numbers when you're evaluating your position, just so you know where your money is coming from. We can see here, for example, if we go over to the P&L, we can see, all right, well, oh, that's a scary number, 666,666. We can see, all right, the position's up $1,740 right now, and most of that is from this 180, 170 put spread, right? But it is like $500 also from this, the 90, 100 put spread, which I put on at a later date. But we can see we're down 660 on the day. Now, if we do some math with our Greeks here, it doesn't make sense for us to be down 660 right now, right? Because we're up $2.64. So $2.64, if we say a delta of 75, so $2 would be up. $2 would be losing $150. We're up about $2.50. So let's call it just conservatively $250 we lost on the delta, right? But we should be gaining $78 on the theta. So let's say 250 minus 80. So we should have only really lost like 140 or something so far today, but it shows 660, and that's very typical with positions. Now, over time, these numbers will make sense. They all do end up making sense over time. It's just that the P&L ebbs and flows back and forth all the time. So this is something you should be aware of if you're going to trade this sort of position, that P&L is going to bounce around. Now, we could look in an hour, and it could have us being up 1,000 or 1,500 today. It just bounces around. And the reason it bounces around is just because some of these markets are very wide. If we look here at the 180 and 170 puts, it's a pretty wide market, right? 33.70 bid at 35.60. Almost $2 wide. Now, this has been up to $3 wide before, but almost $2 wide. The other put here, a little bit over $1 wide. Now, when you are trading in the money puts, right? These are in the money puts, and the strike price is higher than the price of the stock. At a certain point, if they're in the money enough, the ones you are short are going to be, you're going to get assigned on them. Now, so this is a risk which you need to be aware of if you're going to trade out of the money puts. Essentially what happens is, if you go up to these higher strikes, being long one of these puts costs a lot of money, right? If you want to buy one of these 660 puts, it costs $500. At some point, the cost of carry to pay $500 for the put is going to be greater than the value of this put compared with stock. So, and that's why if you look at some of these higher options, you're going to see that there's not very much open interest. And a lot of that is due to these puts being eventually in exercise. So if you are long way out of the money puts and they're high enough strike, you're going to have to be aware that you could get if you're short any of them. So for example, here I am long the 180 put and I'm short the 170 put, right? So when you're long an option, you're in control of it. But when you're short an option, somebody else is really in control of your fate because they could exercise that option at any time. Now, nobody would want to exercise the 170 put right now because, look, the call on the other side is worth 20 bucks. So if I got assigned on this put, it would be great news because all of a sudden, I essentially have $19 for the stock to move where I'm still profitable here, right? So when you're thinking about being short in the money put, you want to look across to the call price and see how high it is. If the call is like, no bid at 25 cents, then you need to check and see if this put is in exercise. And this is something that I may have to worry about when we get closer to expiration. Let's say the stock moved down to 100 this week. As these options got close to expiration and the calls on the other side started going down towards zero, there would be some assignment risk on the put that I'm short. So for example, if we look at the front week with 8 days to go, if someone were long these 600 puts, if someone were short this 600 put here, you need to be aware that you could get assigned on them, right? Because a person who owned these wouldn't really want to pay the 500 bucks to have them on their sheets. They'd rather just be straight short the stock than pay the 500 bucks for these puts. So that's just something to be aware of if you're trading in the money puts, that there is assignment risk as the call on the other side becomes worthless. But back to our Greeks here. So if you have a short, this position here, I'm not naked short options, okay? So my risk is limited. I can't lose more than the account value in this position. However, I am short gamma. I do have risk as the stock moves higher or lower. I have maximum profitability once again between 100 and 170, and outside of those numbers between 170 and 180, I have limited profitability, as same between 90 and 100, and outside of lower than 90 or higher than 180, the position's a total loss. So on expiration. Now, before expiration, if we were to jump today to 200, the position would still have some value because of the chance that it goes back down below 170 before expiration. And this is not a position where I would just leave it. If we were to get close to either the top or the bottom, I would adjust. I wouldn't just leave it and let it go to zero. But the key to making money on a short gamma position like this is just kind of leaving it, right? You want to just let it ride so that this theta, now every day it's not going to come in $76. However, over time, that's going to add up, 10 days, and that's 700 bucks worth. Now, you may not have exactly $760 in 10 days, but you're going to have some money, right? You might have 500, you might have 1,000. This number is going to become more accurate over time, over longer periods of time, and it certainly will come in eventually. And as we get close to expiration, more and more money comes in. If we look at the Analyze tab, it's a good idea for us to take this date here and move it forward and see what happens to our Greeks as time is going to move forward, because we know time is moving forward all the time, right? So let's take a look over and see how this position is going to change over the next few days. So if I were to move this up just one day, let's see what happens. So one day, not much changes. The delta went down a little bit. Let's move this up a week. So let's move this to the 19th. Okay, now all of a sudden I'm short more deltas, right? And I'm collecting more theta at this level. Let's move it up another week. I'm short even more deltas, and I'm collecting even more theta. So essentially, we might want to run this a couple days ahead and say, well, actually, it's showing today I'm short 76 deltas, but you know, in a week I'll be short 100. So I'm really actually, you know, I'm short here. And I should consider in my head as maybe more like 100 deltas than 70, since that's what it's going to be in a week or two. Knowing ultimately that we just need to stay between 100 and 170 in the end. But moving this this forward is something that I do all the time. I'm always looking ahead and saying, what is my position going to be like? The other thing I do sometimes is I'll take options out of the position and say, well, what if I didn't have this put spread on? How much is just the 190 put spread contributing to my Greeks? And you can see here right now, it's contributing most of the theta, and but a small portion of the deltas. It's 28 deltas to the positive, that spread. Now this spread that I'm long is 197 deltas to the negative, so almost 200 deltas to the negative, and 43 of the theta. Well, now remember we have this moved a couple weeks ahead. So let's move back to today for our Greeks here and check this out again. So the 9100 put spread, 59 deltas, 71 in theta, so most of our theta still, and this other put spread, just mostly deltas and just a little bit of theta. Now, once again, if we were to roll down to the middle, you know, the midpoint of this condor is 135. So we would want this position to go to 135 and sit, would be the ultimate, right, for us. So let's model it at 135 here. So let's see. Okay, so let's look at what our Greeks would be at 135. So I'm going to go over and change this to 135. So we would be short. Let me put everything back in. We would be short, or we'd be long 9 delta. So, and that makes sense, right? Right in the middle of our risk, we should be about flat deltas, right? And that's kind of what it's showing there. And so it would be great for us if this just went to 135 and sat for a couple weeks, right? That would be perfect. Nothing usually works perfect in trading, and in this case, you know, we have some problems to the upside here where it keeps kind of getting towards that 170 strike. Now, one thing we could do is we could adjust the position so that instead of having this condor that ends at 170, we could move it up to like 200, right? So we could have it be like the 200, 210 put spread is the one we're long instead of the 180, 170. However, it would cost us some money to adjust the position, right? There's not a lot of liquidity in these options, and for me to move the position around, I would give up some money. It would probably cost me like $600, maybe $1,000 to move the position around, and it could turn out that right after I move the position around, the stock just moves down, right, and we wouldn't have had to move it around at all. So I try as an options trader, you try as best you can to avoid adjusting, right? You want to try to avoid it as much as possible. If you have to adjust, you just want to adjust the minimum amount. That's the way you stay profitable. And we can see, just as we've been talking now, the P&L has gone from negative 600 to negative 154. The stock has hardly moved, but you know, just prices moving around, the P&L has moved. And that is normal. You should be used to the P&L bouncing around all the time. We know ultimately we're collecting money every day, and that will work for us over time. But the P&L bounces around, right? If we were having to pay, let's say, $100 or $200 theta every day, even if it showed us making money, if the stock's not moving, we know that ultimately we're going to end up having to pay that money. It's going to come out of the position at some point. Same with when I'm short gamma and collecting money, when I'm front spread, as we call it, I know that if the stock is just kind of not doing very much, that I am ultimately going to be making money. And that's the way it will work out. The P&L bounces around a little bit, but ultimately the position will make money. And it's weird because this stock really hasn't moved all that much in the last few sessions, right? If we look at the last 5 days, we've bounced from, you know, over here was 154. Now we're 160. But this day, what got up as high as 157, and yesterday it was 157. And it actually showed us having a higher P&L last week than it does now, which is kind of weird. It doesn't make all that much sense, but I know that overall I probably got good marks then, but I know overall that the fact that I'm collecting this money every day, this 72 a day in theta, and the stock hasn't moved, that ultimately I will make money. It's just being patient once again. And having a position like this, if you're expecting to make money on that theta number, you need to leave it for a while. You can't just put the position on and think that, oh, well, I'll make $72 today and I'll take it off, because it costs money to put it on and take it off. And so you're going to have to leave it and let it work for you. And over a large number of positions, over a large number of time, you will see that it actually does work. And you just have to kind of hang in there a little bit. So that's kind of where we are right now. I know it's a little bit longer, kind of a techie video, but that's what it is. Let's take a quick look at the other markets here. The VIX kind of just staying in orbit right now. Let's see if we can move this over. Let's take a look at our numbers here. So VIX 1599 down 7 cents. Overall market not doing very much. E-minis down 4, NASDAQ down 12. Our other stocks, AMC, really not moving, up 17 cents. MVIS down 52 cents. Hood has been kind of falling lately, down $1.79. But really not a whole lot going on, which is what we like to see when we are having a position where we're short options looking to collect money every day. We like seeing nothing going on. So let's keep it that way for now. In a perfect world, I would love to see GME drift back down to like 130, but we'll take it just kind of hanging out here around 160. That works also. And the thing is like, I would dangle, you know, I have this condor on. I would dangle an offer in this condor kind of in the mid-market or higher than the mid-market and just see if someone nibbles on it, just to kind of test the waters. There's nothing wrong if you have 22 condors on, attempting to sell one of them just to see how much liquidity is out there. I want to kind of test the markets. I know that there's not a huge amount of liquidity here, and if I had to get out of this position quickly, I would probably have to sacrifice maybe $1,000. So I would prefer to collect that $74 a day for another month, and then if I have to sacrifice money, then do it then, or kind of let this position ride for a longer period of time. We can talk more about how to get out of a position like this or how to get into it later. I did get into it by first buying the one put spread and then selling the second one once the stock moved lower. But that's for another day. Thank you for watching today, and thank you for your continued support. Please support me with a membership or a like or a comment. All that stuff works. I won't bore you with the other YouTube stuff because you've heard it a million times before. Thanks for watching, and we'll see you next time on the Short Ball Show Live. Ciao.